How do the dynamics around lending in crypto differ from, I mean, obviously you both have, widespread traditional finance background. So how does lending in crypto, given the, kind of 24/7 nature and like extreme volatility, differ from lending in traditional finance?
Yeah, it's a good question. There's a lot of similarities, but then there's also a lot of differences. So like the similarities I would say are um, the style of lending, right? And the structure works pretty similarly in that when we lend dollars for crypto collateral here, it's very similar to a bank lending, dollars backed by Apple stock or Tesla stock to a fund that wants to basically lever up his portfolio holdings. And then if we lend coin, for the purpose of shorting, it's very similar to a company kind of getting a locate, right, or a hedge fund getting a locate to go short through their PB. So like the structure and style of what we're doing is like pretty similar to traditional finance. Obviously, like there's a lot of components that are different. So number one, I think is just like that's the overall size of the market, right? Is a lot smaller in crypto. There's just a lot less, a lot less capital to kind of go around, and there's still a lot of demand for leverage, and so you get like a lot of, really like mispricing and arb opportunity in our space, right? That's why you kind of see interest rates where they are, right? To borrow dollars in crypto, it's cost you anywhere from 5 to 15% over the last 2 years. I think annualized basis traded somewhere in like the low 20s in probably 2020. So like it's been super cash starved market because of just how much less balance sheet there is to kind of go around for a community of funds and traders that like have a lot of appetite to go long. So there's just like a mismatch in really the supply and demand of dollars in our market that's starting to come in, but that's been one huge difference. And then more like operationally and practically, there's differences such as just the 24-hour nature of crypto, right? Like we have to manage margin through the weekend, through the night. And so you really have to be global and have an operations risk, market risk, credit risk team set up to do that well. You can't really do that if you're just working New York hours and you have counterparties in Asia. So really, managing that obviously is a lot different. And I think it's made the market just a lot more competitive to have to do that. And then lastly, like you get other nuanced things such as like having to think about staking, right? And how does that like impact the returns on a loan? Where like, am I entitled to the staking returns? Are you entitled to the staking returns? And things like hard forks and airdrops and how like the ownership rights change over that, depending on is it is it the lender that gets it? Is it the borrower that retains the rights to those things? And then how do you craft that into legal agreements to kind of execute that well? So there's a lot of kind of differences there that just have to be kind of thought through and understood. And then you just have to be, spread out globally and be willing to kind of operate 24/7 to do it well.